All right, class, good morning. Let's settle in and get started. Today, we're diving into the statement of cash flows. Now, I know we've covered the big three financial statements, but this one is arguably the most critical for understanding the lifeblood of a company. We're going to focus on a very specific way of preparing it, what's known as the direct method. Now, you won't see it as often out there in the real world, and we'll get into why, but its power to give a truly clear, intuitive picture of where a company's cash is moving makes it an absolutely essential concept for you to master as future decision makers. So let's jump in. So let's get right to the heart of the matter. At the end of any period, a month, a quarter, a year, this is the one question that every single business leader, every investor, every manager has to grapple with. And I want you to really focus on this because it's a fundamental concept. The income statement, as we've discussed, is great. It tells you if you're profitable based on accrual accounting. But let's be very clear. Profit is not cash. You can't make payroll with profit. You need cash. You can't buy new inventory with profit. You need cash. Knowing where your cash came from and where it actually went, well, that's not just an accounting exercise. For any business, big or small, it is a matter of survival. So to get the answer to that critical question, we have this powerful tool, the statement of cash flows. What makes this statement so special is that it completely ignores all the accruals and accounting estimates and focuses purely on the movement of cash. Now, here's where it gets interesting. There are two primary ways to prepare the most important part of this statement, the operating activities section. You have the indirect method, which is by far the more common approach, and then you have the direct method, which is our focus today. The indirect method kind of backs into the answer. It starts with net income and makes a bunch of adjustments, but the direct method? It takes a much more straightforward path. It just lists out where cash came in and where cash went out. And believe me, that choice of method dramatically changes the story that the financial statements tell. Okay, so for the rest of our time today, we're going to put the indirect method aside and really focus on unpacking the direct method. And what you're going to see is that the concept itself is incredibly simple, almost common sense. The challenge, and the reason it's not the default choice for most companies, lies in the practical application. So our goal here is not just to define it, but to understand why it's such a potent tool for anyone who needs to get a really granular, deep understanding of a company's operation. Let's start with the formal definition, which honestly tells you almost everything you need to know. The direct method directly reports the major classes of gross cash receipts and payments. It's right there in the name. This is a universe away from the indirect method, which, as I said, starts with that accrual-based number, net income. Remember, accrual accounting is all about recognizing revenue when it's earned and expenses when they're incurred, which often has nothing to do with when cash actually changes hands. The direct method just sweeps all that aside. It's a pure cash perspective. The best way to think about it is like a high-level, perfectly categorized summary of the company's bank account activity for the period. So the obvious question you should be asking is, Professor, if the other way is easier and more common, why would any company go through the extra hassle of the direct method? And the answer is summed up perfectly in this quote. It's all about clarity. Put yourself in the shoes of a credit analyst at a bank. A company's asking you for a $10 million loan. Would you prefer a statement that starts with net income and then has a long, confusing list of non-cash adjustments? Or would you rather see a simple, clear report that says, here's exactly how much cash we collected from our customers, and here's exactly how much we paid our suppliers? The second one, right? That level of transparency is absolute gold when you're making high-stakes financial decisions. Okay, so let's shift gears from the what and the why to the how. How do we actually build this thing? Let's get our hands dirty, so to speak, and walk through the mechanics of constructing the operating cash flow section using this direct approach. This slide lays it out beautifully. You are literally just creating a summary of the cash coming in and the cash going out from the company's main business. Let's really zero in on that first line item, cash receipts from customers, because it is so important to understand. This is not the same thing as revenue. For instance, a company could have a fantastic quarter and report $1 million in sales. That's their revenue. But if they sold on credit and only collected $800,000 in actual cash from those customers, the direct method forces you to focus on that $800,000. That number is a much, much better indicator of the company's ability to generate the cash it needs to survive and grow. Now, this all sounds wonderfully simple, doesn't it? But here we arrive at the big catch. This is the main reason you don't see the direct method more often. To produce that simple, elegant report, you need to have systems in place that can track and categorize every single cash transaction. Think about a massive company like Walmart or Amazon for a second. They process millions upon millions of transactions every single day. Their accounting systems would need the capability to tag every single dollar received from a customer, every single dollar paid to a supplier for inventory, every payroll check, and then add it all up. That is a significant and often expensive technological and logistical challenge. And this right here brings us to the central tension of this whole topic. It's a classic business trade-off that you will encounter again and again throughout your careers. On one side of the scale, you have the desire for perfect, crystal clear information. And on the other side, you have the very real-world constraints of cost, time, and complexity. Let's walk through a scenario to make this trade-off real. Imagine you're a senior manager at a manufacturing firm. You're in a board meeting pitching a major expansion, a brand new factory. A key part of your pitch is proving that the company's current operations generate enough cash to help fund this project. If your company uses the direct method, you have an incredible advantage. You can show the historical trend of cash collected from customers versus cash paid to suppliers and make a really compelling, accurate forecast. But then, your chief financial officer might chime in and say, "That's a beautiful chart, but the systems required to produce it cost us an extra $200,000 a year to maintain. We can get a number that is perfectly acceptable under accounting rules using the indirect method, and it's practically free to produce." That right there, that's the tension between the ideal of perfect information and the practical reality of running a business. Now, as you all start analyzing financial statements in your other classes and eventually in your careers, there are a few common traps I want you to be keenly aware of. First, and if you hear nothing else today, hear this. Never, ever, ever assume that net income is a good substitute for cash flow. It's the single biggest mistake students make. A company can report record profits and be just weeks away from bankruptcy because it has no cash. The direct method is like a vaccine for this error. It forces you to look at the actual cash. Second, don't be fooled by a company's cash balance just because it's going up. You have to ask, where did that cash come from? Did they take on a mountain of debt? That's a financing activity. Did they sell off a key factory? That's an investing activity. The direct method helps you isolate whether the core business itself is a cash generator or cash drain, which is the truest sign of its long-term health. So, let's bring it all together. If there is one single, crucial point I want you to take away from our discussion today, it is this. When your goal is to understand the true, unvarnished, cash-generating power of a company's day-to-day business, the direct method is simply the superior tool. It offers a level of transparency that the indirect method just can't match. As you become business leaders, you'll be the ones making the tough calls that directly impact cash flow. Understanding the principles behind the direct method will give you a profound advantage in making those decisions wisely. And so, I'd like to leave you with a final question to think about. In today's business world, we hear a constant demand for more transparency, more openness, more clarity in financial reporting. If that's what everyone wants, and if the direct method provides that clarity, why do the overwhelming majority of public companies choose to use the less transparent, indirect method? What does that tell us about the real-world trade-offs that companies have to make between providing the most useful information and the cost of doing so? That's a deep question that gets to the very heart of financial reporting, and it's something we will definitely explore further when we tackle the indirect method in our next session. Thank you for your attention today.